सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Earlier this year, India's exports crossed a record $400 billion for the financial year 2021-22 and touched $420 billion. Again, in the first quarter of this financial year, there was a strong 22% growth in exports compared to the previous Q1, that is first quarter of last year. And this has been causing a lot of excitement in macroeconomic circles, in trade circles, that India is finally beginning or is on the path to becoming a export-oriented economy, because that is one of the ways for more growth, faster growth, which is how China grew through exports and becoming the factory of the world. And we have been, as we have said many times earlier on this show and elsewhere, that we have lagged on manufacturing, merchandise exports, and generally being a factory because we came late to the manufacturing game. But something changed after that, and exports started dipping sharply. Exports growth slowed down to 2.1% in July this year. And then there was a 1.2 contraction in August, which was a 9-month low of $33 billion. And it was the first time India's exports had contracted in 18 months, 1.5 years. On the other hand, imports have been growing, and imports grew 37% in August, just strong domestic demand. So this imbalance between exports and imports is not good news. And to discuss that, we have Radhika Pandey with us from the NIPFP. Hello and welcome to Macro Sutra. I am YP Rajesh, Managing Editor at ThePrint. Hi Radhika, this is a bit of a disappointing trend, if that word is the right word.
Yeah, so we have been seeing a slowdown in exports over the last few months since this concern around global recession has started to emerge. So it's even in July we saw a slowdown, June we are seeing a slowdown. So over the last 2-3 months we have seen that exports have slowed down, and in August we saw a contraction of 1.2%. So it is mainly on account of subdued demand from advanced economies. From our major trading partners, and that is again because the central banks are tightening the monetary policies. They are raising interest rates, that is harming the demand. There is talk about recession, so that is all now starting to show impact on our merchandise exports.
So we have been talking about global headwinds,
yes.
And earlier we were talking about imported inflation. Now imported inflation is one part of the story. Global headwinds in terms of exports. So what led to this fall in exports? You said recessionary trends in US and Europe and all of that. But is that the only reason?
So that has now intensified further, particularly at the end of August, there was a Jackson Hole symposium where central banks reiterated their demand that they are going to raise interest rates. There are also, if you see, major trading partners of India are slowing down. US is in a technical recession. China slowed down, and China, we have already discussed in a previous episode that China has been facing multiple shocks like slump in the real estate sector. They are also shutting down their factories because they are aggressively following zero COVID policy and also meeting their energy transition to green energy. So there also they are limiting their demand of a number of items. So that is the reason that the demand for exports has gone down. So that is one reason. The other reason is in terms of exchange rate. If we look at our exchange rate in comparison to other countries' exchange rate, we look at something called real effective exchange rate, which is nothing but a country's export competitiveness in relation to other countries' currency strength. And there we see that despite rupee having depreciated, India's currency is still overvalued. So that is also something which is limiting our exports. So one is global headwinds and recession, global growth slowing down. The IMF has projected that trade volume will slow down further in 2023. So that is causing our exports to shrink. But the other subtle point is that our exports are also being impacted because our currency is still relatively overvalued, which is expressed in terms of the real effective exchange rate.
And you have mentioned in your article published on ThePrint Friday morning, the link will be in the description of this video, that India also, the government of India has also imposed some duties on certain sectors,
Yes.
which also makes our exports not very competitive.
Yeah, and that is a part of what we are seeing globally. Many countries are moving towards these protectionist measures where they're trying to first look at the enhancing their own domestic supply measures. So there we've seen a slew of measures in that direction by the government. Export duties were raised on steel, on iron ore, and also on petrol. We've seen that windfall taxes have been imposed. So that did impact our petroleum exports to some extent. So that is also one reason. And from 2017, if we see, there has been a general tendency of increasing duties and tariff rates, which is impacting our trade volume.
One of the, very insightful, I every time you write a piece, I discover something new. And in this week's piece, you've talked about the changing composition of exports and sensitivity to global growth. Because we always think India exports gems and jewelry and textiles and raw materials and all of that. But your insights, what you found from data, is fascinating.
Yes,
Can you explain it for our viewers?
Sure. So if we look at the last 10 to 15 years, we've seen a transformation in India's export composition. So traditionally, we understand that India exports gems and jewelry and other labor-intensive goods like leather, cotton, textile, and so on. But now what we are seeing is that there is now exports have become more high-tech in the sense that they have become more technology-intensive. The technology-intensive commodities like engineering goods, electronic goods, pharma, they have become the major drivers. So there has been a very, there has been a shift from labor-intensive goods to more capital-intensive goods over the last, say, 15 years. So if we just compare, say, 2002-03, the pre-global financial crisis period, and 2021-22, we see that share of engineering goods has risen tremendously over the last 14 to 15 years. So, and that is the reason our exports have become more sensitive to global growth and global demand, because these are the items which are highly sensitive to global growth. And if there is more demand, if there is global demand, then the demand for these commodities is going to rise. For commodities like textiles, cotton, the demand is not that sensitive to global growth. It's the more capital intensive sectors and also services, IT services. They are more sensitive to pick up in global growth and global demand. And that is the reason why global growth has become a very important factor in India's exports trajectory, because our composition has changed. That's very important.
And you make a very important point, a point we have made at ThePrint in the past as well, that the RBI should allow the rupee to gradually depreciate because that will make exports competitive. It is a very difficult balance for RBI also, because that will make our imports expensive. And considering how much oil and gas and fertilizers we import, can this balance ever be perfect?
So there is no free lunch. So that's it's a conflict. It's a policy trade-off. It's just that we need to see which one is less damaging. So now, if we look at if we allow exports to if we allow the currency to depreciate, our imports will become costly. But we need to see what is the transmission of imported inflation to overall inflation. That means how much is imported inflation contributing to overall inflation? And according to RBI estimates, is just 8 to 10 basis points. So if that is the case, it makes sense to gradually allow for rupee depreciation, because if we allow for rupee depreciation, it makes our exports competitive. And given that still we have a considerable proportion of our exports as labor intensive, that will help in jobs, it will help in employment generation, growth, and so on. So that is the policy conflict, that is the trade-off that policymakers have to look at. But given the fact that imported inflation is not the main driver of inflation, it makes sense to allow for gradual depreciation of the rupee, given that in real terms we are still overvalued. So if I may just take one more minute to explain, real effective exchange rate, if its value is 100, it means it's fairly valued. And if it is more than 100, if
and that's benchmark to the dollar.
Yes, no, it is an index. This is real effective exchange rate. So here we are comparing India's currency against 6 major currencies or 36 currencies. So there are 2 variants of real effective exchange rate. So if that index is 100 in simple terms, it means that the currency is fairly valued. If it is above, if it is say 103, 104, it means that it is overvalued, and there is a scope to allow for depreciation to make for exports becoming competitive. So that is the policy trade-off. So there is a case for allowing for rupee depreciation, because again, if we compare with other emerging market economies, rupee has not depreciated to that extent. And the reason for that is that the Reserve Bank has been aggressively intervening to prevent the rupee from sliding. So as we discussed, there have been only 2-3 such instances where rupee touched the 80 rupees per dollar mark, and then again it was lifted. And the implication of that is our forex reserves have come down. Interestingly, just in 1 week's time, forex reserves have diminished by $3 billion. So that is just gives an idea of the extent of aggressive intervention that is happening. And there is a scope for reducing some of that and allowing for gradual depreciation to make exports competitive.
In fact, you make that point, Radhika, that foreign exchange reserves have declined in 21 out of the 27 weeks since Russia invaded Ukraine, and it has come down to 560 billion. There was, I think, 620 billion was the record forex India had built. So $60 billion. $60 billion
already since February till now.
That's quite a fall. And there are countries like Sri Lanka which have 2 billion and 3 billion forex reserves. So you can imagine how much forex intervention has happened from the RBI. One of the key points you argue, Radhika, is expediting free trade agreements and supply side reforms. And India is negotiating a lot of FTAs, as they call them. But also India has stayed out of some multilateral trade agreements and pacts like RCEP and all of that. But these are all things that take a long time. I mean, nothing happens in a year or 2.
Yes. Yeah, these are all medium-term goals, and they are driven by political compulsions. And also experience shows that, smaller countries are able to gain more from FTAs than bigger countries like India. Our own experience with ASEAN and other countries show that India has not gained immensely. But given the fact that there is now a resurgence of wave towards signing free trade agreements, it's a welcome step that government is making some moves towards that, and we have already signed 2 FTAs with one with UAE and Australia. So it is one of the various measures to see that we are moving towards enhancing our exports.
But the big giants in this area are countries like the UK, the US, the European Union, where things are moving so slowly.
Yes, they're moving slowly, and because it's not just FTAs, there are a lot of other pressing concerns that also need to be tackled alongside FTAs to ensure that they move forward. But I think on UK FTAs, we have still made we've covered some ground, and we should see some movement there.
I think Diwali was some auspicious deadline that was discussed in earlier in this year.
Even today, the Commerce Minister has said that UK FTA is something that they are looking forward to, and they've set a new target for trade by 2030 at $2 trillion. So I think we are, at least government is at least recognizing that trade is important, and they are moving towards that.
And also, we will share another article for you in the description of this video. A couple of weeks back, we reported at ThePrint that how the Modi government is now increasingly giving a push to free trade agreements. Earlier, there was a bit of a hesitancy, skepticism towards the usefulness of this, but now it has realized that you cannot be unglobalized or deglobalized because your own domestic industries need a global market. But your last argument, Radhika, is that when the global demand is not so strong, we need strong domestic consumption and investment. But do you think that can make up for poor exports?
So if we look at India's overall growth composition and compare with, say, East Asian countries or, say, China, we have never been a totally export-led growth. So if we look at our exports as a share of GDP, it peaked at 25% in 2013-14. And since then, it has been coming down. So exports did contribute to high GDP growth during the high growth period of 2003 to 2008. Since then, exports have slowed down. And given that now there is a wave of protectionism, deglobalization, raising tariffs, export ban, despite depreciation, there is little that can be done further to improve exports. So we need to look at other drivers of growth also. And particularly in India, consumption is the mainstay of GDP of growth. So there is a need for boosting consumption and investment to promote growth, because by itself, exports cannot be the only driver of growth in the current global situation.
We have a lot of questions, Radhika, so I think let's stop discussing among ourselves and take some questions from our viewers. Akash Sharma, he says, hello YP and Radhika, I'm a regular viewer of the show. Thank you, Akash. Happy to know that, and we need more regular viewers. Do you think India can sustain a 6% plus GDP growth amid the global economic slowdown or recession and limitations on credit supply?
So we know that there are these challenges. We know that there are global headwinds. Earlier, before the onset of pandemic and then the war, it was understood that the medium-term potential GDP growth for India should be somewhere around 7 to 8%. But now, even if India achieves a 5.5 to 6% growth, it would be quite satisfactory, given that there are so many challenges and recession in other countries. So we need to revise our growth projections, our medium-term growth computations, given the multiple challenges.
My own intervention. People are now again talking about we are going back to the Hindu rate of growth, which used to be 3-4%. And not very long back when there was double-digit growth for a couple of years. And the talk was India needs to sustain or go back to double-digit growth if it has to really catch up with an economy like China, or even, for its own progress and to lift more and more millions of people out of poverty, you need double-digit growth. But it's come to a point where we have to be happy with 6%.
Yeah, so that's what I'm saying. Till, say, 2017-18, we were growing at 7 to 8% growth, and then the aspiration would be would have been to achieve a double-digit growth. But given that there was this pandemic shock, we had a contraction, and from 2019-20, we've barely grown at 3.8%. So now we should, for the next 4 to 5 years, look at around 6% growth and focus more on supply side measures, credit, ease of doing business, integration into global value chain. All these will pave the way for higher growth over the next couple of years.
Next one is from Vishwas. Hello, Vishwas. India was recently kept out of the anti-China US-led 11 Nations Minerals Security Partnership or MSP to streamline production and value chains of rare earth and other precious minerals. Looking at our growing dependence from semiconductors to electric vehicles, etc., what can India do to save its future as these two power blocks are keeping India out? Should we just try to focus to strengthen our domestic production, or what can be our long-term strategy?
So one thing that we are doing, or the government is doing, is a production-linked incentive scheme. What needs to be done is to incentivize and to create a more favorable business climate for large corporations to come and set up shops in India, and to see that there is a greater integration of the economy with the global value chain. So we have seen a number of, there is a semiconductor policy, and some companies have shown interest in setting up plants here. So I think all these incentives and removing uncertainty, moving towards tax rationalization, just general improving the business climate and making it simple, reducing logistic costs, all these will help in improving the
Also,
climate.
this is my two-bit contribution to this as someone who has tracked strategic affairs over the years. I think getting into some kind of dialogue with the US, which is such a strong and close partner of India now, to be able to part of this partnership should not be such a problem. I don't see any reason why India cannot open dialogue and become a part of this partnership sooner or later. Because the US is not a rival. The US is not an unfriendly nation when it comes to India's economic interests.
Yes. And despite all challenges, and the US continues to be our major trading partner. Both in terms of trade, also in terms of investment inflows and outflows. So that dialogue has to happen.
Hindol Bhattacharya is asking, how insulated is the Indian economy from world economics such that the worst effects can be cushioned? Also, can you discuss the rupee-based bilateral trade agreements that India is pursuing with other countries?
So the rupee-based bilateral trade agreements was initiated, and the framework was introduced by the Reserve Bank of India to avert some of the sanctions that were introduced, and that will take some time to pick up. It's not India is doing. The other countries are also engaging into local currency trade. So I think that will pick up pace over the next couple of years. It's a medium-term goal by countries to reduce the hegemony of dollar going forward. But on the first question, it is more about how to augment the trade climate and how to cushion and how to make the country more resilient. And on the one side, if we look at the growth trajectories, we see that we are moving still, as we discussed last time, 13.5% growth, whereas other countries are in the midst of a recession. So to that extent, we can say that we are decoupled. But if we look at trade and investment flows, we are going to be impacted with whatever is happening in the US. If dollar index, as we've discussed last time, if it strengthens further, it will lead to outflows of foreign investments, and that will destabilize the market. So there are headwinds from trade and investment channels, definitely. But on the domestic side, the cushion is that our consumption, domestic consumption has showing signs of rebound. So that is one good point.
I'll take the next question from Aditya. In order to tackle outside challenges, providing favorable business environment is quite important. Do you think it is the right time to implement something like a single window clearance system for businesses? What are the challenges in implementing something like a single window system?
Absolutely, that should be done, because if we look at some of the impediments on greater foreign investments in India, one of the thing is high logistics logistic costs, and that is one reason that limit our exports. And if we are able to bring down logistic costs, that will improve export and improve the investment climate. So one of the elements of that is to have single window clearance, fast tracking the multiple compliance requirements, and bringing more simplification. Some part of that has happened with the introduction of GST. Some simplification has happened, but there is a scope to bring in more simplification and more fast tracking of reducing compliances. There was this national logistics policy report where they have targeted that they are going to reduce logistic costs to somewhere around 8 to 10% of GDP, which is required if India plans to become an advanced economy in the next couple of years and improve its exports.
We have two last questions. Rakshit Singhal. What do you think would be the right stance for the MPC to fight inflation in view of its failures for continuous 3 quarters? It's not related to trade. Do you want to talk about it?
Yes. So, MPC should be focusing on inflation because there are multiple headwinds, and the best way in which the MPC can contribute towards improving India's growth prospects is by anchoring inflation expectation. And that is possible if RBI's MPC continues to place its focus on inflation. That is what we are seeing in other countries. That is what should happen here also, that till inflation gets back into the target range, the RBI should focus on inflation. And the other growth, employment generation, all these should be left to the government to handle.
Last question for the day from Ashirvad Kumar. In case of a global recession, which seems quite imminent right now, how badly will India's exports and in turn forex reserves be hit? Because they're already witnessing a tough time due to low growth in manufacturing, and which is reflected in widening CAD. Do you want to put some kind of a number to forex and export growth?
Yes, it depends on how growth shapes up in other countries. What is the extent of tightening that happens in other countries? So that will determine the extent of whether the demand destruction will be short-lived or it will be long-lived. Because if we look at the US economy, which is one of our major trading partners, we are getting mixed signals. It's not that it is in technical recession, but there are a number of other signals that show that US economy is not yet in recession, because we look at consumer sentiments, they are doing strong, they're doing good. Inflation expectations have started to moderate. Employment numbers, labor market are quite encouraging. So if we look at these parameters, US economy is not doing that bad. So it all depends on the trajectory of aggressive rate hikes happening and how much does the Reserve Bank of India intervenes to prevent the rupee slide. Will it allow rupee to fall below 80, or will it stop rupee from sliding below 80? So those are the various policy questions that would determine the exports trajectory.
So there are a lot of policy questions, or various policy questions, as Radhika puts it, that will determine our export trajectory in the coming months and for the rest of the fiscal year. We are already in September, so we have another 5.5 months to go for the fiscal year to be over. Maybe I think $420 billion this year may not be possible, but let's see how it goes. Thank you so much for watching this episode of Macro Sutra. We will be back next week with another new one. Until then, stay safe and have a good weekend.